In this video, I'll be sharing 5 things to look out for when deciding if an investment is worth it or not. And by the end of the video, we would have talked about the only type of investment that always satisfies these criteria. So, stick around. Years ago, I was resuming at a new job. I was determined to learn from my experience at my previous job, where I was earning a substantial amount of money but I could barely make ends meet. So, I made sure to put aside a portion of my salary towards savings and investments. A couple of weeks into my new job, I saw an ad from a popular investment company, a company I still use today for that matter. They had a new product, a growth fund of sorts. So, I invested a quarter of my salary at the time and I waited. 6 months later, the value of my investment had dropped to about half its size and it never recovered. Where did I go wrong? I've since learned that not every investment opportunity should be taken, and I now understand what to look out for in choosing a good investment. You don't want to tie your money down with a crappy investment while the really good ones pass you by. So, what are the questions you should ask when deciding on an investment opportunity? Before we get into it, I'd like to remind you to please subscribe to this channel if you haven't already done so. I'll be making more videos on how to manage and grow your money, and I'm sure you don't want to miss them. Also, don't forget to click the little bell icon so you get a notification immediately the next video is out. Done? Good. Let's go. The first question to ask when considering an investment is, how much am I making? While this may seem obvious, it requires careful calculation. To illustrate, I'll use 2 examples. Which of the following is a better investment? Option A, you invest 96,000 naira and you get 11% returns. Option B, you invest 96,000 naira and you get 8% returns. It's not a trick question. The obvious answer would be option A, if we were looking at the same time frame. So let's adjust the scenarios a bit. Option A, you get 11% after 6 months. Option B, you get 8% after 4 months. Which is better now? Now we need to look at the annualized interest rates. One easy way that allows me to compare both returns is to simply look at how much I would be earning if I were to repeat the investments throughout the year. For instance, if I went with option A for a year at a simple interest rate of 11% every 6 months, that would translate to about 22% for the year. Option B would, however, give us a slight edge with a 24% interest rate because we get 8% every 4 months and we can repeat the investment 3 times a year. While the exact numbers would vary if the interest rates were compounding, this is a quick way to compare 2 similar investments with different rates over different time frames. The lesson here though is to always annualize when determining exactly how much you are making on an investment. This way, you can easily compare with a benchmark like inflation or another alternative investment option. This takes us nicely to the next thing you should consider before going for an investment. What other investment options do I have? This question helps to determine the lowest return you would accept on any investment offer. First off, the lowest return should always be your inflation rate. You must never take anything lower than your inflation rate. In a country like US, where as at the time of this video, inflation is somewhere near 3%, a 5% annual return on your investment will be attractive. In a country like Nigeria, however, where inflation currently stands at 11%, a 5% investment would be a terrible idea. I'm looking at your savings accounts. So let's look at the alternatives. In Nigeria today, rates for government securities like bonds are typically higher than the 11% inflation rate. And they are also relatively safe compared to the other investment options in the country. So, I would always recommend that the second benchmark should be the rates on your government securities. Since I know I can always invest in bonds or treasury bills, I wouldn't go for an investment that offers lower returns unless it's just as safe or offers some other advantage. For instance, with a money market fund, yeah, I know that's my favorite, you have flexibility when it comes to withdrawals and you still get returns close enough to actual money market instruments like treasury bills. Once you've decided on these benchmarks, you can easily strike off the investment options that do not meet these criteria. The next question to ask is, how sure are the returns from this investment? This is where we compare investments with speculation. I'll use 2 examples here. If I found a piece of property in a developing neighborhood and I'm told the value would double in a couple of years, does that make a good investment? Compare that to a small apartment in a crowded neighborhood that I could rent out for a fixed amount each year. Let's look at another example. Compare buying shares in a company because I know or I believe that the share price will go up in future, to buying shares in a company that has a 5-year track record of growing profits and making dividend payments. Which is the better choice here? If you answered B to both questions, you are right. While nothing is 100% certain, buying something with the hope that the prices would go up in the future is more of a speculative move than an investment. In the first example, what if there's a recession and no one can afford to buy the property when the prices go up in the developing neighborhood? Property B will still continue to earn income from your tenants, assuming they don't go broke and start to default. In the second example, share prices are unpredictable in the short run. Your choice of the company to invest in should always be driven by the company's business performance and not by its share price. That way, you are not only certain the company will be in business long enough for its share price to go up, you start to earn from dividends and bonuses from year one. Like Robert Kiyosaki once said, make your money when you buy, not when you sell. On a similar note, the next question to ask is how long can this be repeated? In other words, is the business model sustainable? Warren Buffett once said, if past history was all there was to the game, the richest people would be librarians. No shade to librarians. The fact that an investment works once doesn't mean it can be repeated forever. This is why you need to understand how your investment generates money. I'll use FarmCrowdy as an example. When you pay for a farm unit on FarmCrowdy, the funds are directed towards the farm. After investing and selling the farm produce, the proceeds are shared between the farmer, FarmCrowdy, and yourself. Another example is a fixed deposit with a bank. The bank takes your money, loans it to someone else who pays an interest, say 18%. The interest is shared between yourself, say 10%, and the bank, the remaining 8%. That's a simplistic way of looking at it, but that's essentially the business of banking. Which brings me to the topic of pyramid schemes. I'll be doing a video on how to recognize a scam in the future, but a quick way to identify a pyramid scheme as opposed to a network marketing business is to ask the question, where is the value being generated? With a platform like FarmCrowdy, the value is in the farms. So long as the farms are running, profit will always be generated. Also, the farms are insured against disease and so on. With a pyramid scheme, income is only generated when new people join at the bottom of the pyramid. Those people get paid when other new people join. This is not sustainable, as there's no guaranteed way to make sure that new people will always join, or that the old people will not clear out all their investments as a go, and your investment is not insured in any way. In summary, when you consider a business or an investment opportunity, it needs to be something that can be repeated ad infinitum or is insured in some way. The final piece of the puzzle, the final question to ask yourself when considering or comparing investment options is, how long will it take me to get my money back? The reason for this is what is known as the time value of money. I have already spoken about inflation, but a simple way to look at this would be, if I spent the money today, what I could buy with it today is probably more than what I could buy with the same amount of money in a year's time. This is because prices would have probably gone up by then, exchange rates could have changed, the item I want could be scarce at the time, a lot of circumstances could have changed in a year's time. So a good rule for me is to expect some form of return within a year. For my shares, I expect to receive dividends yearly. I don't buy shares in companies that don't pay dividends. For other investments like FarmCrowdy, I expect returns in less time. I may reinvest the returns or the dividends to harness the power of compound interest, but a year is perfect. You would ask me, how about real estate investments? How do you get returns in a year? I'll do a separate video about my experience in the real estate market in Nigeria, but I'll leave you with this. Building a house to live in is not an investment. However, there are ways to recoup a real estate investment in a reasonably short period of time. We'll cover this some other time. So I promise to share the only investment that always satisfies these conditions. And I'm sure you're thinking, it's probably mutual funds, or stocks, or fixed deposits. Hell no. If you want to know what I think about those individual investment types, you can check out my video on 5 ways to grow your money. However, there's a famous quote from Benjamin Franklin that an investment in knowledge pays the best interest. Jim Rohn is also known to have said, formal education will make you a living, self-education will make you a fortune. I found these two statements to be true in my own personal life. Practically all I've learned on how to grow my money and my investments was from reading, research, and practice. Real life practice. So, the one investment that always yields good returns in the short term and in the long run is an investment in your financial education. The number one way I'll recommend you do this is to subscribe to this channel and invest the time to watch my videos and apply the lessons. I'll be bringing you more videos on the things I've learned from 10 years of trial and error, talking about the mistakes I've made with my own money so you don't have to make those same mistakes. The second best way to invest in your financial education is to read. I'll be putting out a video on the 5 best books that I would recommend on personal finance. A lot of them are classics and they've influenced my philosophy on money and investing, and they've also helped me to make profit. So stay tuned. So those are the 5 things to look out for when deciding on an investment opportunity. If you found this video useful, please do 2 things for me. First, check out the links in the description for other useful resources, and then the usual, like and share this video with 2 people that you know would find it useful. Have a good day, and remember, it's not the size of your paycheck, it's how you use the money that counts.